Okay, why don't we go ahead and get started? There will always be additional folks joining us. I want to thank everybody for attending today. If we haven't met, my name is Joel Reed. I'm very pleased to bring you today's webinar on fundraising, but now during this time of extreme change and uncertainty. We've assembled a dynamic panel of VCs and one outnumbered entrepreneur who I don't think will have a hard time. His company was in the early stages of raising a round when COVID hit and eventually closed that round during this time. So we're looking forward to learning from his experiences. After speaking with everybody last week, I can tell you that this promises to be a spirited and insightful event for anybody who's raising capital currently or anyone who expects to raise capital in the foreseeable future. Myself, I was the CEO of a promising and a still growing company here in Pittsburgh named I Am Robotics. Back in 2018, when we raised a $20 million Series A round, you know, our experience was what we come to learn is a quintessential experience. You have to do extensive social networking to find and build relationships. You do lots of pitching on the phone and in person at networking events, conferences, and pitch events. There's a lot of travel involved, mostly to the coast. And when I was in the Bay Area, we drove up and down the valley, cramming as many appointments we could, spending a lot of time in traffic, and even fitting in appointments from the car from one appointment to the other. You know, eventually we met our investor at our top trade conference, and this conference hosts annually over 30,000 attendees. So, you know, how do you reach all these investors today? Because none of what I just described is possible currently. And hustle has always made a difference in fundraising. You know, so for today's webinar, we're going to have two distinct segments. First, I'm going to turn it over to Jonathan Ellis, who is from Sandalphon Capital. He's going to present to us the results of a survey that look at how VC mindsets and practices have changed. Jonathan is founder and managing director at Sandalphon, and he's currently located in Chicago. He's had an extensive career sourcing, executing, managing investments in venture capital, private equity, and even debt investing across a wide variety of industries. So we're really pleased to have Jonathan. We're thankful for him and sharing the data that he's brought to us. Following Jonathan, at this point, I'll also introduce Afshan Khan, who's going to be our moderator and lead our panel of our panelists today. And by lead, I really mean facilitate. Because they're not going to need any urging, you know, to have a dynamic dialogue. But they're going to have a discussion about the process of fundraising and what's changed. Talk about how deal terms and valuations may have been affected, and also how investor expectations have changed for making their investments. Afshan is a portfolio executive at Innovation Works and is considered an expert on hardware and manufacturing in the Pittsburgh region. She works very closely with companies, advising on critical business issues and evaluating companies for Innovation Works. She's been a CEO, so she knows these critical business issues, such as capital management. And she's held key and strategic business development roles at large companies, including Xerox, where she worked on strategic planning, business development, and mergers and acquisition. Afshan's also a board advisor for the Pittsburgh Robotics Network, and she's a very active member of our events and programming committee. So I'm really appreciative of Afshan's contributions in helping the PRN get off the ground. We're hosting today's webinar in partnership with Innovation Works. IW consistently ranks as one of the top 10 most active early stage investors in the country. They've invested approximately $80 million in over 400 companies. And IW also oversees and partners with Alpha Lab Gear, which is a nationally ranked hardware accelerator where a number of promising robotics companies emerge from. I urge you to please check them out at innovationworks.org and alphalabgear.org. I will post these websites in the chat feature. Also, all organizations like ours rely on the financial support of key sponsors and stakeholders. So today we are sponsored by Cohen & Grigsby, which is a Denton's company. Cohen has been a leading provider of business critical legal services, and they have over 140 lawyers located in offices in Pittsburgh. And personally, I want to thank David Carlson of Denton's, or Cohen & Grigsby, who has been a longtime leader in legal strategies and management for emerging businesses in the robotic space. Through all of his experience, David has become a national and international leader for company formation, venture capital, commercial law, tax matters, and other legal and business matters, all related to robotics companies. So thank you, David, for your support before and during this event. And finally, please, I ask that you take the time to learn more about the Pittsburgh Robotics Network. I'm not going to go into too much detail about our community. If you don't know already, we've grown beyond our Carnegie Mellon roots. We are the worldwide center of autonomous vehicle research and development. We have over 100 commercial organizations that are working to accelerate the adoption of robotic solutions. We have dozens of support and research groups driving innovation and growth. And we're all tightly concentrated in a city, Pittsburgh, that is routinely recognized for being an affordable, great place to live. I like to say Pittsburgh is no longer a well-kept secret. And you can learn more about us and all of that at robopgh.org. We look forward to connecting with you. So that's it. I encourage everyone to submit your questions using the Q&A feature, which will answer those to the best of our ability during the Q&A session at the end. Please do not use the chat feature and try to use the Q&A feature as much as possible. Thank you very much. And with that, I turn this over to Jonathan.
Hi, everyone. Just give me 1 second to share my screen here. Okay. Okay, can everyone see that?
Yes, thank you.
Please nod. Yeah, okay, thanks. Awesome. So yeah, great to be here. This won't be particularly Pittsburgh or robotics centric. This is going to be sort of a generalist overview, but hopefully we can pull out a few themes to sort of tee up the rest of the conversation today. So today we will be covering our Midwest VC survey that we did back in April. Obviously a lot of data is backward looking, and this was a particular snapshot we did during April. I found some more recent data from PitchBook as of the end of June. And so we'll sort of look at how things evolved post-April. And then we'll try and just cover a little bit anecdotally in terms of sort of what's happening today, what you can do about it, and hopefully that'll lead us into the panel discussion. So yeah, around April, I was wondering, like many of you, sort of what was going on, because it all went very quiet and people seemed to sort of freeze up on all sorts of communications and activity. So we did a survey of around 17 VC funds, mostly sort of seed and Series A focus. So this is sort of oriented most towards early stage folks. And I didn't sort of regurgitate them all. You can find them on a blog post or via our website at sandalphoncapital.com/insights if you want to see the full research. But just to pull out a few things, we really started by asking sort of what's going on, what's your current status? And 28% were probably lying when they said it was business as usual in April. They were sort of operate in that manner. And the majority were really sort of focused on the current portfolio at the time, and then were either sort of looking to take meetings soon or really were frozen up. And so the things were really going on behind the scenes there. There was a lot of portfolio company triage. So everyone was, early March, everything was fine. By mid-April, suddenly you're finding that some people's revenue has gone to zero, their pipelines evaporated, churns, all sorts of distress in any given sector. And so people were having to make staff cuts, furlough people, either accelerate fundraising to try and buy more time, or like revisit fundraising plans and extend runway. There's also working from home disruptions, people adjusting to working from home. A lot of VCs perhaps have kids at home and suddenly they have to deal with childcare on top of everything. So like bandwidth evaporated. Some people had never really invested remotely before. Some funds have been doing that all along and continued as usual. Others had to get comfortable really sort of getting to know people remotely. And there's just a lot of fear and uncertainty. We hadn't had a recession since for 12 years, and a lot of VC funds weren't even around that last time. So understanding sort of what to do in a global pandemic and understanding how things are really going to play out. And then even angel investors sort of disappeared as well. Obviously, it's not their job to deploy capital. They don't have a deployment period where they're required to invest money during a 3-year period after closing the fund. They're worried about other VCs sort of not stepping up to close out the round or follow-on funding. And frankly, in the stock market's crashing, I think one day it was down 12%. The real estate market's a bit, questionable. And whatever their source of income or wealth, there's just a lot of reasons for people to hesitate. But April really was probably the peak of all of these things, and as you'll see, it sort of got a little bit better since then. Another thing to just be wary of is that a lot of people are being a lot more selective in terms of who they're meeting with. So bandwidth is constrained. So they're going to be a little bit harder to get in front of. They're going to filter out a whole bunch of sectors where they're, thinking, if you're in the hospitality segment, it's just not a good time right now, or the airline segment. People are just going to be filtering that out and just focusing elsewhere. And so the bar to get in front of them is higher. So there's less chance to sort of sell them in that pitch, and more upfront selling that needs to get done, to even get that first meeting. So, the odds of getting that first meeting went down quite a bit. We also asked sort of really qualitatively, but we extracted a few key themes. What were the things which needed to happen for them to be comfortable sort of investing as usual again? So key point here, 2/3 were basically saying like, there's reasons they're not currently investing. Again, I think 1/3 was probably, looking through rose-tinted glasses when they said their timing's not being affected. But clearly understanding when the economy is recovering, whether or not your startup is really set up to do well in like the post-COVID world and either be COVID neutral or actually get some tailwinds from that, all has some implications. Valuations were expected to decline around 20%. I've seen that in other surveys, other studies as well. There's various reasons for that. Growth has slowed, so all else equal, you're going to get, it's going to take longer to get to a certain point, or the odds of getting to a certain point are lower. So that should be reflected in valuation. There's more uncertainty. So, risk premium to compensate for that uncertainty has gone up. So the required rate of return goes up. So again, all else equal, the valuation goes down. And then VCs like to see a return on their invested capital. So if they give you $1 million, what are you doing with that? What's that going to translate into in terms of value creation? Again, during this slowdown, it's going to be harder to really see that value. So these are all reasons why we all thought valuations were going to go down. It really does vary greatly, though, by very specific company fact patterns. So, this is sort of a general sense, but, as we'll see, some companies have seen valuation increases and others just, aren't seeing, fundraising window open for them at all yet. So that was sort of the snapshot as of April. I didn't want to spend too much time on that because the data is a little stale. So the key thing that I would say we should flag from this, I won't read this whole thing, but I'll send this out afterwards so you can read it. VC investing, it started to unthaw in May. It really started to pick up. The fiscal stimulus, monetary stimulus seemed to be working. The payroll, paycheck protection program, PPP, like that sort of helped. So a lot of the fears were abated, at least for now. And I say for now because, this isn't over yet. Confidence has not returned yet. The economy is not back to normal yet. So, things started to get a little bit better. You did see, with the freeze in Q2, the first half of 2020 really implying around a sort of 36% decline in just the number of seed deals getting done. So seed typically meaning $1 to $4 million round sizes, or around $2 million. So that was, noticeable. And again, should be ticking up in Q3 and Q4, but I think will definitely be down for the year. And this chart is focused on early stage. So PitchBook defines that as Series A and Series B. But on a quarterly basis, you can see that, Q2 is typically a seasonal high, just because everyone that starts fundraising at the start of the year, typically the round closes by Q2. And you were seeing that, the deal count was down sort of 41%. But again, seems to be picking up again. So I don't want to be too doom and gloom here. What is happening though, there's fewer deals happening, but the round sizes are getting bigger and they are going at higher valuations. So that's unusual, right? In the context of everything else happening in the world. So what's happening now is the bar is going up. So the deals that are getting done are sort of hotter deals and more competitive. And the funds that have money to put to work are trying to sort of jam money into these deals, which creates a bit of a bidding war. So it's very favorable for founders and startups with the right story right now, talking to the right investors. But as you'll see, there's other things you can do to sort of try and, if you're not in the camp of being like the hot startup that people are really chasing, there's things you can do to sort of get closer that way. So I'll just quickly touch on this. Yeah, what's happening today and how do you reconcile this sort of hot VC market? If you're on Twitter, you'll see people talking about this is like the craziest time ever, but also people are struggling to fundraise because of COVID, right? So what's happening there? So I think there's really, the whole world is sort of split into two on multiple fronts these days. But you know, those with fundraising tailwinds are typically, you know, coastal startups talking to coastal VCs. The ones that headwinds are non-coastal. That's always been true, that coastal startups, coastal funds really have a sort of easier time raising. So I think the key thing there is making sure you approach both local, regional, and national investors. So, you know, local investors should be easy to get in front of, but the national investors, the coastal investors, you know, if you can get in front of them, you know, you can tap into that capital, and I'm sure we'll talk about sort of the best way to go about that. There's also a distinction between serial entrepreneurs, you know, people that have come out of big firms. They feel like a safer bet, right? So investors are probably over-indexing on how people sort of look on paper. And so, you know, if you're a first-time founder or your team's less proven, you can de-risk through, you know, really proving out your execution. You can consider adding, you know, people that have those kind of resumes to your team, either as an investor, an advisor, or actually on your staff to sort of help improve that story. You know, the world has been segmented into COVID winners and losers. So, you know, if you're in a space which is really impacted right now, it's just going to be really hard, and you probably need to plan accordingly in terms of your capital usage. But if you're in a space which is, you know, benefiting from COVID, or you're able to demonstrate sales through COVID, you know, automation and things like that are really sort of, you know, signaling, really sort of going, you know, the right direction, then you got to be creative in terms of how you signal the momentum and how you sort of prove out product market fit and show that you're in that camp. Warm intros and existing relationships, you know, you see these rounds that seem like they happened overnight. Actually, the relationships have been built over sort of months or even years. If you don't have a good network of investors yet, then you sort of really got to sort of network, you know, hustle to get in there. You can do cold outreach, make sure it's well crafted, not a mass blast. Again, I think we talked about demonstrating product market fit and growth and momentum. Just send out regular emails, be transparent. If remote work is an issue for you because of the nature of your business, you just got to adapt right now. I think if people feel like your business is struggling to, you know, operate, then, you know, you need to do something about that. Some find remote diligence is an issue. Again, given the nature of your business, just make it really easy. So be organized, have a good data room, have videos of the things which you would show people if they came to visit you. And I think the number one fundraising tip is fear of missing out. You know, if you can create some FOMO, you can get multiple people interested in what you're doing, then that's, you know, the easiest way to get your fundraising pulled together. And for that, really, it's not about your idea, it's about execution and showing what you're doing and making it really clear. There's also, you know, still VCs with bandwidth issues. Be empathetic, sort of take your time, allow time to really build the relationships. And then some are still not comfortable with remote investing. So you just got to keep talking to people until you find that they are the sort of right people. And so I'll just wrap up quickly and then we'll get into the panel discussion. I think you know, these are sort of very sniffy little bullet points, but fundraising is sales, right? So you got to really make a really good first impression. You have to continue to make a good ongoing impression, build confidence, build a relationship, make it easy for people to find you, understand what you're doing, make it obvious how interesting what you're doing is, make it obvious what traction you have, build confidence in your execution, right? It's not about the idea. Be patient, allow time. It's going to take a little bit longer to, you know, get in front of people and build that pipeline of investors and then get them over the line. Unless you're a very, very hot startup, in which case you can accelerate that, right? So be methodical in terms of your outreach, be organized with your data room. And really, your job right now is to stand out from the crowd. You know, everyone can be everywhere thanks to Zoom. And so for every one investor, there's hundreds or thousands of startups out there. So you need to be in the top 10 most interesting things that they've seen. And so that should be the bar when you're talking to people. So with that, I'll stop sharing my screen and hand it back. Thank you.
Thanks, Jonathan. That was quite enlightening, both what would happen in the early pandemic and what's happening now. This is terrific. And a person who's just lived through it, co-founder Sutton, Dr. Merkley of Locomation. Maybe we'll start with you to say, how has your experience been? I do understand that you've just recently closed a round. Is that correct?
Yeah, that's correct. We've been fortunate enough to actually do a significant up round, which I'm not saying to brag about it, but that just happened that way. We actually experienced a lot of the things John hit on the presentation. So beginning of the pandemic, the first month and a half, everything came to almost a halt. We are in the automotive space, or we are adjacent to the automotive space. So most of the strategics that we were talking, some of them were even ready to cut a check. They disappeared almost overnight because globally the manufacturing came to a halt. And all of these strategics have their future revenues tied to some certain anticipated manufacturing trends. So they all went into this cash preservation mode. So that all of a sudden made the pie a little bit smaller. Being challenged by remote investment is definitely a thing, although we did not see it being a showstopper. I actually have completely new investors that reached out to me, and they ended up putting in checks, and I still haven't met them in person. Some of them are international. I have people in Japan, I have people in Europe who's literally wired money to me. But of course, this is not something that we can generalize upon. Existing relationships, warm intros, these are very, very important, but these have been how we've been operating anyway. So before COVID, I used to spend maybe about a week, 10 days or so every month in the Bay Area, just roaming around, meeting with new people, attending events, meeting with my existing investors, etc. And what we were able to build, and I think in the end played in our favor, is that we were able to very transparently demonstrate our execution track record. Because every time I go there and I catch up with someone, I tell them, okay, so this is what we've done, and this is what we are going to do in the next 2 months, 3 months, 4 months. And the next time I talk to them, we've done that, or sometimes we've exceeded that. COVID impacted certain execution things. I mean, we are dealing with big semi-trucks, and you have to be around the trucks, and you have to take the trucks out. You have to be physical. Like, there are certain things you cannot just do completely remotely. We've managed to create creative protocols around it and get back to our new normal routine rather fast. And the way we cut through the noise was through execution. That's another very, very important thing. So we basically went on with our execution. We actually put our systems on the public roads and hauled commercial cargo in the middle of a pandemic. And that maybe eliminated some of the questions, or maybe further proved that we are the team to deliver what we set out to deliver. And this might be, take everything with a grain of salt. This might be, at least at this point, be a little bit of a survivorship bias, because I'm just like telling you what we've done. And in this particular instance, it worked. In some other instance, it might not have worked, or maybe luck has played a certain role in it, etc. It's hard to know. We will probably never know. But that was an excellent presentation, John. Really, you hit all the important points that I was going to bring up anyways. We've had investors liking us, and in the end saying that, you know what, I really have to meet you in person, and unless I can do that, I won't be able to complete my diligence, so I'll talk to you in a couple of months. What we tell them is, this is perfectly understandable, empathy is a big part of it, but we basically operate out of a single, very important principle. Every opportunity has an expiration date. So we are executing, and every day we are executing, we are driving, we are creating value, we are driving value. So happy to continue building in relationships, happy to pick up where we left off a couple of months ago, but that's a different deal, that's a different time, it's a different equation. As long as everybody is cognizant of that, I think it is fine. Of course, we are on the lucky end. We are not in the hospitality or travel business. What we are doing, COVID emphasized and maybe accelerated the future even further. Now everybody understands how brittle the supply chain is and how important properly automating parts of the supply chain will be. So we kind of fit into the thesis of the future, and that was completely out of luck. Like, we didn't do anything to bring a pandemic to highlight our point. But everything aside, I think, yeah, execution is key. Staying focused is key. I'm not going to say this is a numbers game, but you have to have the grit, and you have to keep pounding, keep hammering. And you have to keep talking to the right people, not try to convince the wrong people and try to bring them aboard. Just try to find the right people, and there are right people. So it's an interesting process. It was very formative, and now we are also battle tested. So hopefully that's gonna also help in the future.
Thanks, Sachin. That's actually a great segue into the folks here, other folks here on the panel. The fundraising process, like you mentioned, you used to spend 10 days out of a month in the Bay Area knocking on doors. That socialization, I think Homan refers to it as a social sport in terms of building your network and building understanding and getting awareness of your company and your vision and your mission. So I actually want to start with Melissa and ask what has changed, Melissa, for you on the East Coast in particular in terms of fundraising. I know that so many investors up until recently, as Jonathan's survey pointed out, were focused on portfolio firefighting. Where do you see things now? What do you feel is happening in terms of your existing portfolio and new deals?
Yeah, well, so I don't invest only on the East Coast, but what I can talk a little bit about are what are some of the macro changes that I think are happening. I think the data that we were looking at is really helpful, particularly if you're new to the language of venture. I think it can be very level setting to just wrap your head around the realities of 1,500 companies getting funded out of all the companies in the world, right? I do think the risk of that data is could give first-time founders a false sense of homogeneity. This idea that venture is a monolith, it's not at all. There's incredible diversity across the country, even within regions, around how funds are structured, what their motivations are, how they select. Essentially, when you break it all down, that pattern matching is more like farming than hunting, right? There are deep roots that go well beyond what you might read, in TechCrunch or in a headline. So I think if you are in the audience and you're a first-time founder, I do think thinking nationally about where you might fit is critical today more than ever. I think it's always been true, but we tend to hang out where we are, right? And I think you have little pockets of activity, and that made us feel okay. I've had the privilege to spend quite a bit of time in Pittsburgh and aware of how much Pittsburgh has dedicated itself to creating connections to funding sources outside of Western Pennsylvania. So most of the work that I've been doing, both for my portfolio companies and then those that I mentor who are more focused on raising large venture rounds, is to cut right to the chase on being geo-agnostic and really doing the legwork to skip ahead on the pattern matching, to go deeper than the top tier funds that everyone talks about, to look for those who have dry powder, have capital, and are really committed to the ecosystem. Now, in this case, we're talking specifically to those that are building robotics-driven businesses. So that really does a lot of work for you by narrowing the field. I think what I am seeing are behaviors that regions have becoming more pronounced yet again. I think we had a prep call and we talked about an experience that I had where for a while I felt like the East Coast and the West Coast and the South and the Southeast, that the behaviors were beginning to normalize a little bit, and that we were starting to see more parity in those ecosystems, with Silicon Valley always being an outlier, just having its own ecosystem. I think that with different regions being differently affected by the economic recession brought about by COVID, we're seeing a return, I think, to less parity. And so it becomes more important for the entrepreneur to be very cognizant about the lens they're using, and are they using a regional lens or a national lens? So I think I'm seeing a lot of different reactions. And so I would just encourage everyone listening to take the high-level data as a way to jump into your learning about funders, but recognize that all that is falsely averaged in a way that that I think really obscures just how much diversity and depth of practice that there is in the funding community, and to find someone, if you're new, find a capital mentor who knows a little more about it than you do, so that you can kind of skip ahead past that data and past those headlines to get more granular about a capitalization strategy that's going to work for you.
Terrific.
Well,
and
I would actually agree with most of that, but like the most important point, I think, or the word was relationship, right? Because nothing, from my opinion, has necessarily changed about the right way to raise venture capital. But kind of as Chetan was alluding to, I think the cost of a mistake right now, is much higher. And what ultimately drives the decision to invest is that someone really cares about you and your company, right? So, getting the highest score and poll of the audience is irrelevant. That one person or two people or three people that want a really deep ongoing relationship are what drives your round success. And the more you focus on human ties, communication, good business fundamentals, and actually building relationships, the better off you are. And that's true now. It'll be true 2 years from now. It'll be true 2 years ago.
I think, Ashton, that's kind of this idea that sometimes fundraising language gets very, very predatory. Like, you are the hunter and the VCs are the prey, right? And I actually think the farming metaphor is a little more, as for me, in my experience over the years, it's really a lot more about thinking beyond the hunt and more about planting seeds and nurturing those relationships. Sometimes a little hunter metaphor gets your blood boiling and you're ready to go. I get it, it's exciting. But if you think about your overall capital kind of trajectory, it's a long-term game. And I don't know anybody that goes hunting for 3 years, right? But I know I know people who farm.
I think you definitely get us some deep society metaphors here, right?
I actually have to jump in here.
When done well, it's very much, farming and long-term relationships and planting seeds. But when you're unprepared, trying to raise money on a 1 month notice with, poor financials, it does get pretty predatory pretty soon. So maybe the farming is the good scenario, the hunting is the bad one.
Oh, I'm sorry to jump in here. This is great. Already some wonderful things being shared. But one of our participants reminded me that I did not introduce you folks. And I think since we're already well into
Just skip it. Yeah.
They want to know about you. So Melissa, as part of Rev Up Capital, if you could each give one sentence going around. Melissa first.
Yeah, I'm currently managing director of Rev Up Capital. I'm actually running a revenue-based fund now. I was in early stage equity for a long time and became very frustrated by the constraints of that model, but still relevant to this conversation, still actively involved in raising equity dollars for my companies. It's just not what I do anymore because I think it's boring.
Okay, Chris, you want to just give one side of you?
Sure. I'm Chris Merla, managing director of a series of venture funds based out of Pittsburgh that invest in robotics and augmented intelligence, pre-seed through B round and what we think are ambitious, enterprises that actually tackle, a major problem with society.
Okay, terrific. Homan.
Yeah, I'm a partner at Fusion Fund in Palo Alto, California. We invest in technically oriented companies in enterprise, industrial, and healthcare sectors. And big fan of the Pittsburgh ecosystem.
Terrific. And I think, Jonathan, you have introduced yourself, but maybe one quick line would be great.
Sure. Yeah, Joel kindly introduced me. But yeah, I'm the managing director of Sandalphon Capital. So we're a Chicago-based pre-seed through Series A fund focused primarily on the Midwest and underserved markets.
Okay, terrific. Thanks. And Sutton, we've already had the introduction, so great. Thank you for that terrific imagery of predatoriness. And one of the things you pointed out, Chris, was, when you think about building relationships in this Zoom world, I mean, like any minute now, I'm afraid I'm going to freeze on the screen for everybody, so just beware. But it is hard in a Zoom world to build relationships. And as I believe Homan had pointed out, it is a social sport. So, there's a lot of different folks listening here. Some of them are very, very early stage, earlier than what was defined by PitchBook. What skills do you need to fundraise effectively in this virtual world? You don't have those trade conferences anymore, as Joel pointed out. It's difficult to network. It's difficult to do meet and greets. Anyone want to jump in on what suggestions there might be for founders and companies to sort of pursue getting to start to build those relationships if they're new in their fundraising plan?
Well, I mean, I guess maybe I'll just kick that off. I mean, at least from us, one of the things we like to see the most from our founders before we invest, is resiliency. And while there's certainly a ton of challenge to today's environment, it is certainly a great environment to also prove your tenacity as a founder. So don't do anything creepy, like, don't show up in people's front yard with a boombox and things like that. But, there are ways to still get in front of people. network science is, I think, one of the biggest kind of fundamentals to good fundraising. And just, you know, there are ways to meet people even virtually.
Yeah, I was going to say, I mean, I've been able to meet a lot of good people online, and for founders, I think, going back to what we talked about earlier, relationships are really important. And one part of relationships actually is references and who you get connected to and who's going to vouch for you. And I think that's really important. So figuring out who, let's say you're trying to connect to a specific person or group of people, having someone vouch for you to that group is super powerful, especially in these days where maybe someone can't meet you. That's just another kind of angle or flavor of how someone can get a gauge of, you know, your personality, your background, you know, your true work ethic. And I think that really helps a lot of people. And I was saying in our prep call, you know, the whole virtual environment right now actually in some ways can help a lot of the founders outside Silicon Valley in working with Silicon Valley investors, because, you know, whether you're in Pittsburgh or you're in San Francisco or in Sunnyvale, there's no difference to me anymore. You know, I think the potential disadvantage is that if you don't have a strong you know, referral or connection that can help vouch for you, that could be an issue too. But, you know,
yeah,
all these things together just help kind of round out your ability to connect with the person that you're trying to meet.
I think there's good news and bad news in this moment. I think the bad news is that the systemic bias that was built into capital networks wasn't fully flushed out pre-COVID. And if we tell ourselves that it was, I think we're doing an incredible disservice, right, to first generation entrepreneurs, people of color, women, and especially those living outside of top tier geographies. Yep. I think on the upside is there's a new generation of investors and fund managers who are as committed to finding good founders as founders are to finding them. And I think there's a lot of stuff right now that's experimental. It's a little weird. I just spent a week sitting on my ass doing 20-minute company meetings for a conference that's based in Tennessee that I usually attend. But we met these founders, and those founders showed up, and I showed up, and we made it happen. And I think if you have a network and connections, of course, you're going to defer to those and you're going to use those. And that's going to make a really big difference. So right next to that are other ecosystem ways for you to plug in. In Pittsburgh, there's a community of folks who care about early stage companies. And you're an idiot if you're not reaching out to those people every single day, trying to get them to connect with you and give you ideas on how to move forward. And so you need to be doing that. But let's just say that you don't have access to that, or that's too slow. I think you need to be Googling your way to victory and finding places and spaces to experiment along with us to make sure that you're not sitting passive, kind of cold emailing, hoping for the best. So I think there's some good news, bad news there. And I know Jonathan has been doing some really interesting work. I just filled out an incredibly exhaustive survey to help me find companies through your network. And I did it. But I think that primarily what you really need to do is get your shit together. You've got to get your story together. You're like, I think it was Chris who said that the cost of a mistake is pretty high these days. You're not going to get 3 bites at the apple, and people aren't going to open up networks for you if you don't deliver. There's even apps now that I know people use that when they make an intro to me, they send me a link the next day asking me just how it went. Very easy for me to click a frowny face and you're done. So I think you really, really need to be, you got to be honest with yourself about where you are, what your fundability is, what your assets are, what your story is. Buy yourself a ring light so you don't look like you just came from the zombie apocalypse, and experiment and kind of get on with it. I do think that the imperative though is for us as ecosystem champions not to just expect the entrepreneur to evolve to meet us, but for us to evolve to meet them, or else we're going to miss another generation of entrepreneurs. And a lot of the work that we've accomplished in the last 10 years of broadening the top of the funnel is going to shrink again. And I think, so I think it's really a two-way street. And I think we need more platforms for investors and founders to just talk to each other about how we're going to continue to make connections when we can't visit the same town and sort of have a cup of coffee together.
No, I think that two-way street is a really important point. I mean, because, you know, just like the cost of mistakes for, let's say, entrepreneurs are higher now, it's the same with VC funds. I mean, I've known a couple of funds that we've co-invested with for years that started slapping out predatory term sheets and not really being fair to people trying to raise money from them. And I'm not going to like magically forget that in 6 months when, you know, this goes back to normal and it's a good environment and their term sheets normalize. You know, so even though it's harder and a lot of the burden is on the company to form relationships, a good VC is the other way around, right? So I don't want to say like know your rights, but know what's fair to you. And if people aren't doing that, move on.
Yeah. Just to add up to what Melissa was saying, you know, I think best practice for sort of networking is just show up, be helpful, like give, like, you know, whether you want to call it goodwill or karma or the favor bank. You know, if you're showing up like, hey, can you introduce me to so-and-so? Like, it's not going to feel good and like, it's not going to go anywhere. But if you're just showing up and you're genuinely interested in people and you're being helpful to them, they'll be helpful to you. And so as much as like the warm intros and the network-based sort of filters, you know, can be a little exclusionary, if you're in robotics, I would hope that you are connected with other people in the robotics space. And if I'm interested in the robotics space, you will overlap with my network, right? And if you reach out to me and we have 0 mutual LinkedIn connections, I'm wondering who, you know, if you're like a fake person, right? So I think that LinkedIn, it's not perfect, but it is a hugely valuable tool. You know, if you find a portfolio company that's similar to you or complementary to you, reach out to them. That'll get you into a VC potentially as well. And then I think the other underestimated tool is Twitter. And again, you don't have to find the exact right person, but Twitter is pretty open, you know, pretty transparent in terms of communications. A lot of people have their DMs open. You can find not necessarily the right person, but the person that can introduce you to the right person. If you just invest a bit of time engaging, socializing. Don't be a weird stalker that always comments on a VC like every time they post or always likes everything, but just, you know, engage genuinely, be interested, and, you know, reach out to people. And it's not so much getting that right person immediately, but always 1 degree away from who you need to be to.
Thank you. That's great. So go ahead, Chris.
Oh no, go ahead. Didn't mean to just talk over you. Go ahead. I come back.
The joys of Zoom, right? You know, those are really, really good points. And there's a lot of different ways that I think in some ways the same theme arose. And I think maybe Sutton can give an example of what he went through when his investors, his strategics, as he said, disappeared overnight. He had to, you know, retool essentially. One of the things that Melissa pointed out in our prep call was, you know, in some ways, a lot of folks are a lot more approachable because they have open office hours. They're looking to network, as you folks said. You know, try to be in the top 10, top 15% of, you know, of interesting companies and interesting founders. But if you don't have your shit together, it's really one shot, like you said. So Sutton, when you had to retool and think about your raise, what did you do to sort of say, okay, you know, how do I regroup and how do I reach out? Because those international folks, I'm assuming, did not find you on their own.
One of them did, but the others did not. So I went back to, I was very fortunate to have a great set of existing investors and their networks, and everybody was basically helping me and making introductions and facilitating stuff. So what everybody else was saying about what Homan was saying, for instance, is very important. Not just a warm intro, but there's a difference between a warm intro and someone vouching for you. Having people who will vouch for you it was maybe 10 times more important in that particular domain, because everybody was all of a sudden everybody were in a dark room and trying to find their way, and any clue that they can actually trust were extremely more valuable. So we were in a very fortunate place to have a great set of existing investors and a great existing network. Again, like pleasant random things also happened, but mostly it was a structural retooling, structural relooking at the network. Okay, so who would be interested in actually participating in an opportunity like that? The opportunity itself is even bigger and even better, because it's now very apparent that we are looking at a very, very big value creation possibility downstream. So that lined up some certain people. That did not line up majority of the people. Whoever were skeptics about the overall landscape or the overall application, mostly remained skeptics. But we were able to reach out to brand new people who had been thinking about this, who had been thinking about what kind of disruptions will come to the supply chain on autonomous driving, autonomous trucking, and in what form. And we were able to find a couple of very valuable new investors. Now they are a part of the family, that our thesis lined up very, very well. And from there on, the rest is history. It was very rapid progression.
Actually, I think if I think about how that translates maybe to the listeners, I think there's always been three questions that most investors want to hear you answer. They want to hear you answer why now, why this, and why you, right? And I think through time, those different questions are weighted a little differently.
Mm-hmm.
And I think the why now and the why you right now are really, really important. I think the why this is a little more squishy. I think we're all open to recognizing that there's a lot of dynamism in business right now, in how you operate, in your product, how you deliver value, all this stuff. But this why now, timing has historically been one of the leading factors in why, if a company succeeds or not. It's not how much money they raise. It's, was it the right time? Was it the right time for the intervention? And then the other, like if there's two parts of the sandwich, the other bun is this why you, right? Are you the right team for this job? The why this is, it kind of depends, it varies more on its importance depending on the fund. But I think right now, you've got to think deeply about the why now. Why is now the time? Is it because it's a quiet before the storm? Is it an emerging opportunity made more poignant and visible? Is it preparation for what's to come? Is it just picking up demand that's been created in this crazy upside down market? And then I think, thinking about Sen for like the why you, really being able to tie that to the team's execution capability, its timelines, its future-looking strategies. If you can't master that, I think you're probably dead in the water. So we tend to focus on the why this. We tend to focus a lot on our product, what we do, how it works, and we kind of ignore the why now and the why you. So I think I would focus on those two things.
That's fantastic, Melissa. That's great. So Homan, what are you seeing? When we had our prep call, you talked about how activity had picked up, quite dramatically in the Silicon Valley area, and we talked a little bit about a variety, as Melissa had pointed out, disparities between expectations between the coasts and sort of in the middle. What are you seeing in terms of traction expectations, deal terms, any portion of that in terms of the activity out there?
Yeah, a lot of what we're seeing in Silicon Valley agrees a lot with what Jonathan presented. Things started to pick back up a little bit in May, and I would say by July it was, full force. It was like COVID never happened, and actually August same way. There was no August slowdown. Like I recently did a deal where I had to bust my ass in 2 weeks to finish my whole diligence just to get a small check into this company. Things are going crazy. I would say valuations have gone back up. I would say they're probably as high or higher than they were pre-COVID or during COVID. I'm seeing, seed rounds raising at, 10 million on 50 pre with not much traction, but it's because it's a super strong or pedigreed team, at least to the appearance of the investors. So that's a lot of craziness, kind of like the stock market. You wonder what the hell's going on. And now with a whole bunch of SPACs and IPOs coming out, there's just a lot of capital flowing out. And I think, to Jonathan's point, while firms don't necessarily have to put out X dollars per year, I think there's some, kind of gut feeling, I need to put some money out this year. And it's going to be interesting actually to watch the next 2 months. I do think we're going to have a super accelerated fundraising season in September, October. And then I do think it's going to shut down by November 1, a little earlier than normal. Partially, everyone's going to be distracted by election day. There's going to be, I think people are burning out this year. There's going to be expectations of family life, okay, maybe we have to quarantine now for the next 2 weeks if we want to travel somewhere for Thanksgiving, or schools are actually shutting down by Thanksgiving just to give people time to figure out what to do for the holidays. So there's going to be a lot of distractions in general. And then people just throw in the towel and say, hey, I'm just going to wait till 2021. But things are very, very active right now. And it's amazing to see how much money is flowing. And part of that is also because a lot of people left companies or left startups, I would say, in the COVID area. And now we see this new cycle of venture starting again. So we see new people starting up new companies, new areas, kind of like what Melissa said, like why this person, why now? And these people are fitting that equation. And so we're seeing a lot of deals get done.
So in part and parcel to that, you invest outside. You invested outside the Valley. You invested in IM Robotics and other companies. How do people find you? Who aren't necessarily in the Valley or connected to you?
Yeah, for us, we try to build a lot of networks in different areas. We're I like to think we're pretty strong within Pittsburgh because we are big fans of the ecosystem here. But we try to be very open. We try not to take this Silicon Valley approach where you know, there are investors say, okay, if you're not within some 25-mile radius of, you know, Silicon Valley, we're not going to talk to you. That's, you know, I think that's pretty stupid mentality. There's a lot of good companies in a lot of different industry hub areas. And so I think for us, like I said, we focus on a lot more B2B industrial enterprise type companies. We look for those types of founders in certain areas. So that's usually, you know, how we like to kind of spread our tentacles.
That's fantastic. And in terms of autonomy and robotics, a lot of our viewers are autonomous and robotics focused. Chris, what have you found in terms of companies reaching out to you in this region for assistance and introductions and networking and funding?
Well, I mean, you know, it certainly hasn't slowed things down. And I think with us, we've kind of hit kind of a double hit from the deal flow perspective, because of course, one, there's very few active investors right now, and we're one of them. And then two, we also invest very heavily in hardware, which at the earliest stages, there's not very many investors to look at. So certainly it has been a bit more of a triaging the inbox and phones. But I think, you know, what that means is kind of what everyone's already said so far. You know, the more you have an actual human introduction to a person, the more likely they are to actually get back to you, and they're now 5 times bigger email volume. You know, the more there's actually touch points, you know, that they can go back and look at. Like, I mean, one of the things that Jonathan mentioned, I think it's especially right now, is Twitter and LinkedIn, right? The more people can go online and see proof that your company exists other than your own direct assertions, I think the better. And I would slightly disagree with Human on the whole November thing. I actually think the quarter 4 of this year will be gigantic from a deal flow perspective, because the US LP markets are opening up very much towards the end of the summer. And usually VC activity and LP activity have a 3-month delay. But that being said, this is a really uncertain environment, and it is worth emphasizing that none of the people on the webinar, myself included, can predict the future with any accuracy. So, you know, I think the one thing that does come across as consistently important is resilience and persistence. You know, you look at, you know, Chetan, they had to replace an investor in their round. We've actually had to replace several in rounds, both we've invested and then rounds in us. You know, so it's just a tough time. As much as we'd like to give assurance that we know what's going to happen and can give you good advice, we might be wrong. So just persist, know why, know your story, know why it matters to not just you, but your audience, and stick with it.
Yeah, I mean, I agree. Like in these times, I mean, hustle is always important, but like right now you have to be really good at hustle and really good at adapting. Things are just changing all the time, and you just don't know what's going to happen. So I totally agree with Chris. Like if we could predict the crystal ball, we'd all be rich.
Yes, very much so. And so, you know, we've talked about it, and everyone has mentioned this. You know, you've got to tell your story and you've got to show traction. But I can tell you, I work with a ton of companies who could not get in to see their customers, who could not do their pilots in person, who had folks who just, you're MIA. You know, they were talking to them one week and then they disappeared. It's you know, the traction expectations. What has changed there? And someone had mentioned asset-based storytelling. Now more than ever, if you're trying to sort of highlight and shine, how do you do that in this COVID environment where, you know, maybe your contact is through a Zoom link, even if you're getting a warm intro to a customer? How do you do that when, since I deal with hardware companies, they can't get physically in front of their customers? Anybody can jump in.
Well, so I would say you actually still could get in front of your customers the right ways. We've had several of our companies, even the hardware ones, do in-person demos. But I mean, the biggest thing, more so than ever, is empathy. I mean, if you know you have to go to a customer's facility and demo a hardware product, you know, start with safety, right? Like, address why they don't want to get back to you before they don't want to get back to you, and they're less likely to not want to get back to you. I mean, it's just, you know, I would say, I'm trying to actually look at my notes while I talk. 100% of our companies have been able to demo a product to a new customer in the last 3 months. There's some people that are legitimately not answering phone calls. I would say that's less than 1% of your customer list.
Anybody else
People will
have any
talk.
different experience in that? Because I have companies who just can't get in there. They just can't, even though there's interest. I mean,
Well, but I mean, that's always true. And I would say if they can't get in there, there's not interest, right? You know, and that might not be the company's fault. I know several people that are, you know, on hiring freezes and on spending freezes, and, you know, they can't access their corporate card anymore. But that rarely cuts across an entire industry segment or market, right? So if customer X and market Y, you know, isn't getting back to you, go talk to customer X.1 in market Y, right? Like, if your business is dependent on one person calling you back, your business is going to go poorly at some point.
Yeah, I think you've got to get creative as well. I mean, you know, if you have to get in, you know, in front of them to demo something, then like, yes, you just got to find the right customer. You know, if it's a matter of you can't travel, then you know, but they are physically somewhere where they could engage with your product. You know, can you like ship it to them to try out and then they ship it back? Can you record something really good? Can you do some like, you know, interactive webinar? You know, there's technology tools, you know, AR, VR, you know, there's other ways to demonstrate it. You just got to get a little bit creative on the demoing side of things.
No, I mean, I've known one company that's mailed out Oculus Rifts to key customers and did a virtual demo.
Yeah.
It's fantastic, right? Yeah. And free Oculus, so of course you're going to answer the phone,
being
right?
an entrepreneur, being an entrepreneur is just a series of like finding a hurdle, finding a problem and overcoming it. And, you know, this is just like another one. So you just got to get creative, I think. And in terms of traction, like there is just some businesses right now where, you know, customers are just not going to turn into paying customers right now. But there's other ways of showing momentum, showing product market fit, right? VC is we're a forward-looking game. So, you know, ideally, yes, revenue is great, but it's sort of like, well, what's 12 months from now look like? So, you know, people always talk in terms of like, you know, run rate, revenue multiples and things like that. Really, everyone's looking a year or two in the forward. So if you can be, you know, pre-selling or, you know, building a pipeline of POCs, and so like, you know, your closed deals are not there, but you have this big bulging middle that's sort of moving along. And then as you interact with investors, show that it's sort of, you know, more people moving further along. So like, it's all at the cusp. And when things get back to normal, we're off. You can still show that momentum even without closing deals. So again, I think
this is really similar to this sort of false homogeneity, right? Even the word traction. We all talk about it like we're all saying the same thing. Traction is not the same as market signal, and the threshold for some funds is market signal, not traction, right? And so I think you've really got to put yourself you've got to see yourself in the framework that you're aiming for. And if you're really early, then you're not demonstrating traction, right? What you're looking for is ways to show market signal. And if you can get creative, I think to Jonathan's point, to try to find ways to get other members of that ecosystem, potential buyers, strategic partners, other players in the ecosystem to signal for you that there's something in the market that's awaiting you. And when you're in a hard tech vertical like this, plenty of hard tech companies get funded before they have traction. So I think part of it is, if you're in the audience and you're new to this, is you've got to kind of go below the buzzwords and you've got to figure out, what is this? Who am I talking to? What are the criteria for investment for this fund? And if you are a really early company who has no market signal yet and you don't have any traction yet, then don't go to a fund where the threshold for investment requires that, right? You've got to be more dynamic in thinking about what's the right next lily pad on your journey across the capital pond. And it may be that for some folks, that means right now isn't the right time to look for institutional venture. It may be a better time to go find individuals that are passionate about the industry and take these risks all the time. It may be that there are non-dilutive partners out there in research and in grants, and then also customer-funded R&D and customer-funded development is one of the least discussed but most powerful ways for early-stage technology companies to move forward. So I think part of it is just take the words and just challenge yourself to figure out what it means, really what it means. But then most important, what does it mean? What does it mean to you? And then how do you integrate that into your story in a way that's gonna help you engage the audience that you want to engage?
Well, yeah, I definitely think the theme of dynamism is really essential, right? And of course, what it means to you is one thing, but I think the most important thing is what it means to your customer. I've seen a lot of people have problems selling robots, let's say on a fixed price now, but the same people going back with a low-cost lease that actually pays more over the life of the robot are having, way more success. So certainly, if you could show you're making someone's business better, people are still out there buying stuff heavily, but making someone's business better might be defined in a 3-month window, not a 2-year window. And I think there's ways entrepreneurs can adjust to that, is no water off their back and a lot easier for customers.
Yeah, it goes back to, I think, oh, go ahead, Chen.
Very, very quickly. So this was a learning lesson for me in the last several months, not just in the COVID, but overall. This is actually another way of looking at how you are filtering potential investors, because you really need to understand if the potential investor actually understands what kind of business they are going to invest in. So in our particular case, we are a deep tech company. We are going to be on the roads, that's our hypothesis, we are going to be on the roads several years before anyone else, but that's still several years from today. So we are still building the technology. So there's no way for us to reasonably show a linearly increasing revenue. Some funds that I was talking to many months ago, they said, oh yeah, we usually come in at, I don't know, $2 million yearly revenue. And I was thinking, there's no $2 million yearly revenue for us. It's either 0 or $200 million. There's really nothing in between. And if they don't, if it doesn't fit their investment thesis for any reason, or if they don't understand the dynamics of the industry they are about to invest in, they are not a good fit anyway. So even if they want to give you money, you're probably better off without their money.
Yeah.
This goes back to
I was just going to say, going back to what Melissa said, but, signal is very important for both the customer and the investor, right? So, I mean, full disclosure, I'm an investor in Chetan and his company, but, Chetan really recently did a pilot and, put some PR out there, and all of a sudden within the industry and within the investor class, people started going, hey, Chetan, we should catch up. Like, interesting to see what you've been doing. And, a lot of it's been just that, some PR, as what Chris said, getting stuff on LinkedIn and Twitter. You're real, you're having, momentum, you're having interest. And I think people see that and they go, oh, I should, talk to the person. And you start building on that. And so there's all these things on how to be creative about how to reach your customer, whether it's the investor or the actual customer, right? And right now everything's online. So digital marketing, social media, things like that, that all helps you get in front of who you want to get in front of.
Yeah, I guess just to wrap up this thought, going back to what I was saying about making it obvious, right? Yeah, there are investors that say, you need $1 million or $2 million of revenue, and that's a very lazy way to gauge product market fit, momentum, traction, like whatever you want to call it. It's very arbitrary, and if actually, like Chetan's case, you're at 0, but there's high probability visibility to a much bigger number, make that obvious in the deck, and be like, not in a kind of over salesy bullshit way, but in a way that when you like, high probability pipeline of X, when people dig into diligence and they talk to a couple of your customers, like that's true, because then, but even those investors, like I want to invest in investments, it's B2B SaaS, it's pre-revenue, everyone else passed, no revenue, but they had, multiple high probability enterprise contracts. I wasn't taking a flyer, they were like already late stage, and when they converted, now they're, 8 figures of revenue. So you can, as long as you make it obvious and then back it up in diligence, then I think you'll cut through, again, that layer of people that perhaps aren't a fit if they're just being lazy and filtering based on revenue.
Well, but I think to Chetan's point, though, one of the best things you can do is identify the people that are going to take an arbitrary stance based on randomness and get rid of them quickly. Because that's more time to spend on the people that actually get your business, will dig into your product cycle, and what milestones are kind of meaningful to you. I mean, because, one of our hardware heavy companies that I'll anonymize just because I don't know if they'll be telling the story, just hit a similar problem on a round that actually ended up closing very, very well for everyone. And they were having tons of investors talk about that arbitrary 2 million line in the sand. And actually, if you go to this nice report that Silicon Valley Bank put out recently on robotics VC, you'll notice that before 2 million, there is a massive drop in valuations. After there is a massive spike, specifically because of that kind of, let's just say, arbitrary number that's been lemminged across the industry. But if you find the right people quickly, that doesn't matter. And the more you can get it out there that, hey, we're not this. This is why it matters that our product is actually well established right now. This is why we're not focusing on this particular arbitrary line in the sand, and why you should be excited that we're not. And while the majority of investors won't like that, the right investors will.
So I don't agree with Jonathan's take that those traction metrics are lazy or arbitrary. I actually think deciphering them is very important. And it actually really fundamentally explains how different funds see their exit path, right? And what the milestones are for follow-on raise and exit multiples in different industries. And I don't think that having a mathematics for that necessarily reflects laziness. It certainly doesn't for the funds that I work with, both equity and non-equity, where they do have mathematics around revenue growth and revenue projection, particularly as it relates to how attractive that company is going to be to an acquirer in a space, or in the case of an investor like me, ultimately what our opportunity is on that investment. I think what it matters, where it is sort of lazy and arbitrary, is on the part of the founder who wastes time dialoguing, beyond the education part. Sometimes you need to dialogue with a bunch of people just to understand the world. But I think there's a huge difference knowing about your own company, what your own capital strategy is going to be. Are you going to be a highly capital intensive company that is a long way from revenue? Awesome. There's a whole bunch of people who are really into you. Are you the kind of company that's actually going to be, you're going to need modest capital, but you're going to use revenue as an important indicator of where you fit in the market? Then there's a group of funders that are really into you. Are you fast to revenue and maybe your exit potential is kind of low, but you have a pathway to become a $20 or $30 million company? There's a huge group of funds that are going to be interested in you. So for me, I don't think looking at things like revenue and some of those metrics are lazy so much as they are incredibly indicative of whether or not you're farming in the right field.
That's a perfect jumping off point to
looking at it too firmly. It is lazy, because I think to both Chetan and Jonathan's point, the overall trajectory of revenue is what's important to VC returns and exit multiples.
So that's a perfect
classes of products like Chetan's, like most hardware, it's a much more, let's just say exponential curve than it is a linear one. This arbitrary $2 million revenue bound was calculated specifically off of customer validation in enterprise software. So applying it to non-enterprise software is lazy. And I know we got to move on to this, so I'll get off my soapbox.
So perhaps then there are a subset of funds that I haven't had a lot of experience with that are acting lazily. I just think for the audience listening, I think it's maybe the better way to think about it is I think everything in investing is arbitrary. It's all speculative and it's kind of all arbitrary. Like we've made all this up, right? Over time together, the investors, the founders, the industries in which we all converge. But I think that it is just something to be thoughtful about as you're just placing yourself into the ecosystem to kind of know where you fit in that narrative, and how victimized are you going to be by those arbitrary standards? How do you utilize them or leverage them when you think about which capital partners are going to be the right ones at the right stage? I definitely understand what you're saying about the sort of arbitrary passage of mores from one industry to the other and how detrimental they are, and really thinking about, and good investors think beyond that. And anyone who doesn't is in fact lazy. And there are lazy investors out there. But I think it's just, if you were listening to this conversation and it was your first time and you didn't have experience with that, I think you could walk away with a slightly skewed assessment of the burden on you to explain around what your capital needs are going to be and how you're gonna fit into that. So, but I don't think anyone else wants to listen to Chris and I go back and forth about this any longer. So,
okay. So thank you all for everything. This has been a very open and honest conversation. And as the folks listening know, this really was not scripted in any way. Everybody was just sharing exactly what they want to share. I want to jump into the questions before we have run out of time. One of them really important, and Melissa, I will ask you shamelessly for a plug for Operation Athena. One of our questions is about female founders getting less than 5% of the investments, is it worth trying to fundraise if the chances for female founders are so small?
Yes, it's definitely worth it.
Of course.
You have different work to do, and you need to surround yourself with a different team of advocates and supporters so that you can not fall into the same potholes that I fell into when I was a founder 15, 20 years ago. Yes, you should try. All businesses need capital. All businesses have to have a capital strategy. Unless you are super independently wealthy, you're probably going to need to think about outside capital to grow your business. Yes, it's absolutely worth it. And there's a growing community of investors that are thoughtful about disassembling some of the bias that has, I think, existed in our world for a really long time. So yeah, it's definitely worth it. I know for me, I've made a lot of conscious decisions. I made 6 out of 9 investments in the last 12 months were into women-led companies. And then then I made other investments to a bunch of dudes. Like it's, but there, yeah, I don't even know, other than to say, yes, please don't try, because the historical realities were grim. I will say, just in general, know that threading yourself through the venture needle is a tiny, it's a rarefied act, right? So just be thoughtful about making sure that you're not doubling the chances that you're wasting your time by jumping ahead into a funding environment where your company isn't well positioned to receive that funding. So I would say for any founder, if you're up against historical bias and all kinds of systemic bias, then you have to make sure that you're being very efficient and spending time in the right places. But yes, definitely try. Please try.
Yes, great, thanks. Go ahead, Chris.
No, I was going to say that, the point Melissa just made about, think hard about venture capital, I think is a phenomenal one, right? Because I would say 90 to 95% of small business in the US would actively be disserved by taking venture capital too early. And I think 90% of them will be disserved by taking venture capital ever. For the ones that are in that 5 to 10%, it's a great way to build your business, but it's perfectly okay if you're not in that 5%.
Yeah, I just want to echo what Melissa said. I mean, please do try. I mean, there are investors out there who, are very active in removing these biases. And so, as Melissa said, focus your time on the right investors.
And one of our questions that fits perfectly in this, what would you share with a female founder who's having difficulty raising and is considering bringing on, I'll say it, a pale male founder to help make fundraising easier? Any thoughts on that? Jonathan is saying no.
Yeah, no, I mean, that's just not like the right reason to bring anyone on to your team. It would be my reaction. I mean, I think ever since the Me Too movement, I mean, this is a big problem, and it's going to take a while to really correct, I think. But since the Me Too movement, there's been a big diversity and inclusion push. I think people are now more cognizant on their pipeline. I think more and more people are being encouraged to be transparent on diversity stats within their funds, which, again, increases the incentive to be focused on the pipeline. There are female founder-focused funds. There are underrepresented founder-focused funds. And then I think, now I think even at the institutional LP level now, diversity and inclusion is becoming a focus. And if investors continue to not think mindfully around that and do what they can to, ensure a good pipeline, get rid of the biases, then the institutional LP money will disappear. And the ones that are adapting will be the ones that survive and thrive. So, I think being on if the person in question here has like additional skills that would otherwise be value additive to what you're trying to do, then that's a good reason to bring them on. And some people, founders don't always have to be CEOs. Usually they are initially, but I think it's okay to bring on a co-founder as long as it's for the right reasons.
Yeah, and I think the right reasons point there is the key one, right? Because the people you're going to be working with on your business are going to be your closest relationships, just human relationships, not working relationships, for the next 5 years. Who you pick, there needs to be some sort of deep, ongoing strategic meaning for why they're there and why you think you'll be able to productively work together. And if you react to superficial or unfair concerns overly tactically, I think you're doing yourself a disservice for a lot of the reasons Jonathan mentioned.
So I always had to have a guy in the room to be taken seriously, and I think it's important not to be glib about that. I think there are other ways to think about gaming the system. I don't think early on just replacing you as CEO with a dude. There's probably other stuff going on there that's not going to resolve. But I think it is totally gross, but completely one of the acceptable options to think about who you put on your advisory board. Who do you use as air cover? I mean, I don't like it. But it has been, I'm 46 years old and I just started getting taken seriously in a room. It took a long time. And I've had to have a lot of air cover from my male colleagues through all of through my career in many of its permutations. I started out in biological life sciences when there were no women in science. I started a company when there were no women founders, and I became a fund manager when there were no women fund managers. And without the men who acted as Russian icebreakers to give me any space at all, I probably wouldn't even have been here today. It's super gross and disappointing and frustrating, and I cry a lot about it. But I think what you need to do is get good advice from people who have been there and who can give you some sentient, thoughtful ways to get the social credentialing that you need to create the relationship with the person you want to create it with. But you want to be really careful trying to fake your way through that, both because any valuable investor will smell it, they'll see it, and it's probably in the end not going to get you what you want. But the additive consequences of integrating that into your company DNA, I can't see any scenario where where that's the necessary option. But I say if you're a woman founder and you're in robotics and you're out there, you need to have some credentialed guys associated with your company to be taken seriously by probably 80% of the ecosystem in which you're playing in.
Great, thanks. So one of the other questions, and many people have this question, is what's the biggest difference with respect to fundraising for a robotic startup between Pittsburgh, Boston, Chicago, California? I'm going to ask Seton because he even had international investors come in at the last moment in his raise. What's the difference that you've seen with respect to fundraising?
I mean, not
oh, sorry, I asked Seton first, just for his firsthand experience. Sorry about that. I don't know if he's frozen. Seton, are you frozen? Okay.
And can you repeat the last 15 seconds? I'm not sure if I was frozen, but you definitely were frozen on
I'm sorry. What's the biggest difference with respect to fundraising for a robotic startup, whether you compare it, fundraising in Boston or Pittsburgh or Chicago or California?
I don't know if I have statistically significant answers to speak about that. I mean, we've been talking to folks all over the place, and on my cap table, it's actually almost like we have East Coast people, we have Pittsburgh people, we have Midwest people, we have West Coast people. So it really is it's not about the geography. Of course, there are geography somehow dictates the maybe particular investment thesis or focuses, but there are enough people in every geography interested in pretty much all the verticals, and ultimately it is about finding that one person in that community. So I really don't think it is particularly easier or harder just based on the geography.
I think in each of these communities, you got to find like the people that are really pushing. I know in Boston, we have a Techstars Air Force program run by a really talented guy named Warren Katz. And he full on shamelessly established this program just to help more companies get SBIR2 grants. And it worked. And that has been transformative now for 25 companies that have gone through that program and have been able to use that kind of non-dilutive funding. And then that's partnered with, they have a program where the Air Force is really actively finding ways to build civilian contracts, paid contracts with these companies and into the industry. And so I think in wherever you are, either go to those places, right? Or, sometimes it's just subtle. It's not what you think, right? And there are weird ways that robots are so cross industry, right? I mean, there's interesting stuff happening in the Midwest. There's interesting stuff happening in advanced manufacturing. In Tennessee, I spend time in Chattanooga, hashtag said no one ever, but turns out I have. They have transportation logistics expertise that's just exploding. And I know that the integration of robotics and AI into that community has been a huge priority for them. them. And they have crazy money that's going into that. And who thinks of Chattanooga or Tennessee, right? For if you're like, if you're in healthcare robotics, right? Yeah, right. They're like, that shit's amazing. So part of it is, again, just where if you're in the Pittsburgh bubble, which is a beautiful bubble, by the way, it's an I always joke that when I go to Pittsburgh, you can throw a brick and hit a roboticist, but good luck finding a digital marketer. I mean, it's an incredible community. But you know, you can do yourself, I think, the favor of looking at how other ecosystems, like what's their flavor of that, and do you maybe need to grow out of your bubble and into that bubble to just find that next resource. But the country is actually filled with some interesting stuff that you just might not read about, you know, on the headline of the Pittsburgh paper, I guess.
Yeah, one of my greatest frustrations, to be honest, over the last years, and definitely pre-COVID, was that a lot of Silicon Valley investors invested in the robotics companies that were based in Silicon Valley, but there might have been better ones outside. And part of that is, I think, just you know, proximity bias, you know, presence. And that's why I always suggest to our founders who are outside Silicon Valley, you guys spend at least like a week, a month in Silicon Valley just to get that face time. But now it's different, right? I mean, I think this is where things could change, things can shift. And I think people are realizing, hey, there are actually great companies and probably better companies outside Silicon Valley in this area.
Yeah. I was going to bring in the Chicago.
Yeah, I mean, you know, as a Pittsburgh based, oh, sorry, go ahead.
I was going to bring in the Chicago perspective just real quick. I mean, to Melissa's point about homogeneity, right? You know, there are investors of all sorts everywhere, right? Now, I think the advantage of being in Pittsburgh is Pittsburgh's DNA with Carnegie Mellon and stuff is very strong in robotics. So all of the investors nationally are looking at Pittsburgh for robotics startups versus, you know, in Chicago, there are people here, but like, we're not really known for robotics here. Like UIUC is a strong school, but, you know, that's further downstate. And, you know, I think, you know, Chicago versus Pittsburgh, I think you're better off being in Pittsburgh where the talent's in Pittsburgh, the technical talent and the investor focus. And which I hate, you know, dismissing Chicago, but like, it's just not a core strength for this market.
And I mean, you know, there's the talent, of course, but it's just also really cheap to do business here. I mean, we have, by volume of inbound deals, more deals coming to us from Boston and the Bay Area than in Pittsburgh. But by fraction of the ones we actually do, I mean, we're well more than 50-50 Pittsburgh. And one of the consistent, you know, strengths is the talent. But if you also look, just to anonymize another company's data, you know, look at one of our earlier investments, they got cash flow positive on a hardware heavy company off of 500K. Doing that in Boston would have cost almost 4 times as much money and probably 6 times as much out in the Bay Area. So there's some serious strengths here, and there's serious strengths in Tennessee and Boston. It's just, again, building the relationships and knowing how to communicate your strength to the right person that cares about that.
That's fantastic. We have a couple more questions before we want to wrap up. Here's a quick one, and then we'll have 2 more questions that I'd love everybody to comment on. Quick question was, we're a team ages 40 to 60 with 2 successful exits. What kind of age discrimination will we face when fundraising?
Sorry, do you mind repeating that?
We're a team ages 40 to 60, yeah, like me, with 2 successful exits. What kind of age discrimination will we face when fundraising? Homan, do you want to take that one on?
Yeah, I mean, there's definitely, it's a great question. And I think a lot of it depends on, to be honest, again, which firm and which investor you're talking to. Some do have that, unfortunately. For me, it's just, can I feel the hustle from you? Do I feel the passion from you that you're going to work, you know, you're going to bust your ass in this company and find the right ways, even when all the doors are closed to you. That's kind of what I like to look for. But that's me, and everyone has their own different kind of investment kind of mentality or thesis.
I'd rather invest in a high energy, like scrappy sort of 60-year-old than a, you know, lazy 25-year-old. So actually, and the stats, someone did a study on this, and I think actually entrepreneurs over the age of 40 perform better. So, you know, as with all that, I think it's also true of female founders. You know, if people actually pay attention to the stats, then the things which are discriminatory are actually an advantage if you play it in the right way.
I think the only archetype you got to be thoughtful about, and I don't think that I read that question in chat. I don't think those 2 have this problem. I think you'd be a little careful if you're like the 40 and 60-year-old like inventor. dudes who, you know, really have a lot. Like, I think if your sole skill is in technology, you may want to augment that by demonstrating that you have the capacity to build an organization in a market forward way, which is going to require you to build an organization that is inclusive of all different kinds of talent, including younger talent. And sometimes that may be around just, are you really up for the rigors of staying dynamic on the operating side? If you are 40 and 60 years old and you're dynamic operators and you know your technology, I invest in 40-year-old people all the time. But I do think there is an archetype in science-related businesses of the inventor who can sometimes lose sight of the value of keeping the operating side of the story fresh by demonstrating that they know how to build an organization that has all the parts and pieces. So that's probably just like the archetype that I think gives that a lot of, where most people experience that in this kind of industry.
Fantastic. And so we have time for one more question, and I'd love everyone, starting with Jonathan, to just sort of comment. You know, as you investors and VCs, what are some intriguing ways that an entrepreneur can leave an impression right now through this digital interaction? Sort of, what have you seen, or what would you like to see that would really work, would really resonate with you as an investor? That leaves an impression to say, hey, I want more, I want to learn about this person, and you know, they're new to you. Jonathan, do you want to take that on?
Yeah, there's no gimmick that I would say in digital world you should do, right? I think if you come to me with a well-prepared pitch deck and you're all over your your Q&A, and you can really compellingly communicate the business, and then the follow-up, some of the best investments I've made were the founders at the end of the call will be like, okay, what are your outstanding concerns? And so I'd have to, like, based on the conversation, lay out exactly what my concerns were. And then by the next conversation, they've addressed them. And in the end, I run out of reasons to say no. And like that ability to kind of close the deal in that way, then also translates eventually to revenue because they're doing the same thing with their customers. So that follow-up and like demonstrable execution over time is probably for me the highest thing in terms of building confidence. And people say they invest in lines, not dots. And like, when you get that first dot, create a really nice line so you feel really good about the trajectory of where things are going.
Great. Chris?
No, I think that was a good answer. And I mean, with us, very similar story. One of the things I got to say is, I mean, as I mentioned earlier, like email volumes, call volumes, all of that's way higher in the pandemic. And a lot of the founders that have successfully moved through our pipelines, if I'm slow in evaluating kind of their operating model or getting back to them on a product idea, send a very polite reminder saying, hey, it's been 3 days, still interested, what can you do to help? And, don't let me lose focus, right? And I think being on top of the relationship building in a way that's not creepy, aggressive, or weird is really important.
Great. And Homan, do you want to mention maybe Homan, Melissa, and then what Seton may have used in his real-time fundraising? Homan?
Yeah, for me, I mean, Zoom is hard, and a lot of us I think are on Zoom calls all freaking day. So your attention span is less than in person, right? So you're really keeping like the pitch and the message to 30 minutes and not longer, and really trying to get everything in there. And as Melissa said, even like little details like getting the lighting right, just making sure your internet connection is good. I mean, all these little things that can add friction, you don't need that. Make everything as advantageous to yourself as possible. Yeah, and I just want to say, there's a lot of good resources in Pittsburgh that can help with, connecting to the right investor. There's Dave Mawhinney at Schwartz Center. There's other groups who are just really good at connecting you to the right people to be efficient. And I think that's really important these days, be efficient and then hustle.
We closed a couple rounds for some early stage companies just recently. And I think right now, having that ability to project authenticity more than just one-way storytelling, like the ability to actually respond to something I say, maybe not in that first conversation, but over time. I think when you can see, like, there's always that first pitch. In the first pitch, it better be like, why now, why you, why this? It better be concise, yada, yada. But like, let's say we're kind of into a dialogue. when you can actually watch how a founding team evolves the story and how they're able to make amendments and adjustments to the story that recognize maybe vulnerabilities in the story or things that are still in flux, that really sticks with me. And I really appreciate that when a founder has the ability to really engage in a conversation about their business, when they just don't get stuck on that kind of rote repeat where they're just telling me all the things that they already told me, but where I can see what, kind of how they're evolving their thinking. And I think a lot of it just manifests as in finding a way to be your authentic self. And for some people out there listening, this may not be their first gift, right? Company storytelling, presenting themselves as a competent storyteller may not be their first skill. So I think, putting in the time to practice that with people close to you, like in low risk environments, increases the chances that you're going to be able to have that kind of dynamic conversation and express that kind of authenticity that's going to make me want to enter into a kind of a long-term relationship with you.
And Satin, what was your experience?
I mean, really, there is no silver bullet. I think it's a combination of everything, from small details like, show up a couple of minutes early on the Zoom calls and make sure that your slides are up there. So the very first thing people see is the puppies that sits behind me. So that all of a sudden grounds things and like gets you to a head start. Good storytelling is very important. It's necessary, but it's not sufficient. I think what's even more important is to actually have a compelling story to tell. And how you tell that is then going to be very important. And this is sales, just like everything else, this is sales, but saying that in a dry way, this is sales, kind of takes away and makes it into a transactional thing. It's not that transactional. There's a transaction at the end, but you really have to be genuinely true to yourself, and you really have to be passionate about what you are doing. And then you really have to work on how you are going to give that message. You really need to have a personal issue about getting your message across. So you really need to want deeply and very badly people to understand what problem you are solving and why it matters. And then, of course, why you are the right team and why this is a good opportunity and why everybody would like to succeed, et cetera, et cetera. But it starts with having a really compelling story to tell and really believing in your story.
Well, thank you, everyone. This has been tremendous. I know I could go all day if my internet connection would let me. So I want to be very, very thankful and appreciative of everyone participating. This has been fantastic. I hope everyone on the line has gotten a lot of good suggestions and ideas and thoughts about this, and I'll turn it over to Joel.
Thank you, Afshan, and thank you, everybody. What a great conversation. We certainly needed more time. We took a couple extra minutes. Jonathan, thank you very much for the data. Afshan, thanks for the moderation and some thoughtful questions and leading us in the right direction. Melissa, Homan, Chris, thank you very much. We really appreciate your expert opinions and giving it to us straight. And Chetan, congratulations on the fundraise and good luck the rest of the way forward. Thanks for sharing your experience. Great insights. As you can see, not much has changed. Fundamentals about building relationships, being prepared, more important than ever, right market timing, getting notice, also being selective in your fit. But there are some new things to consider. We're doing demos remotely, the timing of investments by the industry, and perhaps Googling our way to victory and making sure that Zoom is working. And we actually put our videos on. It's very important for the engineers in the audience. Show your face. It's still very important to see humans. So real quick, we made a recording of this webinar. It's going to be available in a follow-up email. We're also going to ask if you have the opportunity to complete a survey so we can continue to improve on these in terms of what you want to see and how we're doing these events. Thank you, Cohen and Grigsby. Thank you, Innovation Works. Really appreciate your support. Special thanks out to Rich Lunak and David Carlson. And I want to thank everybody for attending today. If you have any other questions, feel free to follow up with me. I'll be happy to make some connections for you or to be able to help you directly. You can always come to our website at robopgh.org and follow us on Twitter and LinkedIn. Everybody have a great day. And if you're going out raising funds, as we said, get your shit together and good luck. Bye. Thank you.